Welcome to our live stream, and this is my coverage of the UK budget for 2023, the autumn statement. And I'm just going to go through the key points of the statement and also talk about some of the more detailed stuff that you might not get from just looking at the headlines. But I will start with a summary of what was done and what I think are the most important changes. And there will be time for questions at the end if you want to stick around. So let's just get cracking with the forecast. Please do like and subscribe if you just joined us. So let me just start this off and we'll begin. Great. So let's just start off with those big changes. And I think probably the biggest one is to do, if you're a pensioner certainly, will be the pension triple lock, which some people thought would become unaffordable, but in fact it's a fairly small cost to the government. But effectively, the triple lock for pensions, which ensures that they remain in line with inflation or wage growth or 2.5%, whichever's greatest, that's going to remain in place. And that means that pensions will rise by about 8.5% from April of next year. So that's important for pensioners. There's going to be a cut in NI contributions. So it's moving from 12% to 10%. And then if you're self-employed, from 9% to 8%. So that's going to have a big effect on employment, probably reasonably big effect on employment, and certainly a positive effect on GDP, on growth. Although we'll see the actual numbers in a second from the OBR, it's not so big as you might think. Then we'll also mention the expensing. So this is the ability of companies to write off the business investments against their income, and that way they pay less corporate tax. And that's going from something which would have expired in 2026. Now it's going to be permanent. So that's the plan anyway. Welfare recipients, also there's going to be a kind of clamp down on them, and if you don't get a job within 18 months, you have to do work experience, and if you don't look for work for a 6-month period, you're going to have your benefits stopped. So fairly draconian measures, particularly if people genuinely can't work, and some people are obviously going to slip through the net who really can't work. So I think this is a little bit of a difficult one, but still the idea is that one of the problems we've got at the moment is that lots of people have left the labour market after the pandemic due to long-term disability, and the feeling is that some of those can work from home, for example. So if that works, it could increase the amount of people in the labour force, and that would reduce inflation. So that could be positive from that point of view. And then finally, business rate freeze. So that's in place for retail, hospitality and leisure. And that's a very expensive measure. It's going to cost about 4.6 billion. We've already had a rate freeze for several years, but for retail, hospitality and leisure, it'll carry on a bit longer. So if you're a pub, good news. But again, it's just a reprieve because it's only going to be frozen for a year, one more year. So now let's talk about the political backdrop, because I think this is really important. Whenever you hear one of these government giveaways, which effectively is what they are, it's really just a way to curry favour with the populace because you want to get re-elected if you're a politician. And so really it's as much as you can give away as possible to the people who are likely to vote for you in order to kind of curry favour with the electorate. And if you look at what happened since the disastrous budget of Liz Truss, you can see what happened to the polls. The opinion polling for the next UK general election, it went from fairly close Labour versus Conservative polling to a huge Labour lead as a result of that incredibly incompetent management of that budget, which of course was almost exactly a year ago today. So that was September of 2022. So yeah, at the moment we're looking at a 20 percentage point difference between Labour and Conservative. So really this budget at best, I think, would just narrow that gap it's very unlikely, in my opinion, I'm not a political commentator, it's very unlikely to make Conservatives win. I think it'll just reduce the size of the losses if it is effective. So just bearing that in mind, I think it's worthwhile also to look at the long-term perspective in terms of tax. And one of the points that the Institute for Fiscal Studies has made, and this is simply an empirical fact, is that this government is currently the highest taxing government since the Second World War. So let's take a look at the definition of how we got there. It's really to do with fiscal drag. And the definition of fiscal drag is that the government freezes tax thresholds. So if your wage increases, and for many people they're going to be jumping over one of those tax thresholds and paying more tax, then what's going to happen is they're going to be dragged into paying a tax at a higher rate. So that's what the word drag refers to. It's not what you might think. Government income as a result goes up, and the beauty of it is, from the politician's point of view, is you can say, look, I didn't change the tax threshold, I didn't change anything, which is true, but simply by freezing the thresholds and not making them increase with inflation, you're raising taxes. You're kind of dropping the threshold for tax to be paid, a higher rate of tax. So fiscal drag is responsible for a big increase in the tax take over the last year or so. So if you look at the tax revenue in the UK, and as always you compare it with gross domestic product, you can see that it's true. If you go all the way back to 1948, it was something like 37%, and at the moment we're looking at something like 36 and a bit, not far below 37. And it turns out that as a result of the changes today, it's still the case that this will be one of the highest taxing governments ever, since the Second World War at least. So of course the Conservatives are not spinning it as something which is like a high tax parliament which they've been running, but it has. And the increase in tax is also one of the largest between this parliament and the previous one over the last 13 years in which they've been in power. So it's interesting, if you listen to the Institute for Fiscal Studies, this is Paul Johnson, who's the amazing director of that institution. He says these tax cuts won't be enough to prevent this from being the biggest tax-raising parliament in modern times. And he's got a nice article about that, which you can find on the IFS website. So now let's look at growth, because of course one of the things that the government is very keen on is to stimulate growth in the UK. If you remember, the Bank of England forecast almost no growth for the next 2-3 years. The Office for Budget Responsibility is a little bit more sanguine about growth, but still not incredibly sanguine. So let's have a look at those forecasts. And you can see the forecast from the Office for Budget Responsibility in March. That's the yellow line. And the updated version based on the latest data and the latest policy change from the government is the blue line. So the good news is that it is higher, and we'll talk about the reasons behind that in a moment. But if you compare the forecast from the OBR versus, say, the Bank of England, you can see that, say, for example, we compare 2026. The OBR expects growth to be 2%, which is okay for a developed market country. And then for the Bank of England, you're only seeing 0.8, so much less positive. But of course, this was before we got the latest changes to policy. So the next time we'll see the monetary policy report from the Bank of England will be springtime. So that'll factor in the latest fiscal policy from the government. So it'll be interesting to see how much that changes their forecast for growth. What's slightly more worrying, I think, is the prediction for inflation, which is comparable between the Bank of England and also for the OBR. The OBR is a little bit lower. It's the same for 2024, 3.6%. For 2025, the OBR expects inflation to fall to 1.8. The Bank of England, which, let's face it, should know about inflation because they tried to control it, they're saying 2.2, so higher than the OBR. Anyway, but the important thing, I think, is looking at the effect of all of these tax cuts on what happens to UK growth. Because the UK, however you look at it, whichever forecast you look at, growth forecasts are very low. It's nothing to be excited about. And these changes are not particularly large. The largest impact on growth, according to the OBR, is the cut in national insurance contributions. The way that works is, if you're paying a smaller tax, and remember employers usually pay it for their employees, that means effectively employees become cheaper to hire, so that could increase employment. And I think the estimate is that it's going to increase employment by about 28,000 people, which is a 0.1% change in the unemployment rate or the employment rate. So not a huge shift, but because those people will be earning more, spending more, it can have second round effects, and that's going to have a positive impact on GDP. And in fact, that's the largest contribution to GDP. So that pushes it up by about 0.175 percentage points. So instead of something that was close to zero, you get something which is slightly less close to zero. And then the other big contribution is the purple thing, which is based on demand. The thing which is initially negative and then turns positive, these kind of dark green lines here at the bottom, and then positive here, is the cut in full expensing. So this is creating more investment by companies, both in their employees, you educate your employees, and also in equipment, the quality of their plant machinery, for example, if they're a manufacturer. And that initially will cause them to bring forward their expenditure, but it's not going to have a huge positive impact until we get to 2027, 2028 and 2029. That's when it turns positive. But again, the magnitude of the increase in GDP, pretty small. So overall, the effect on growth, I'd say, is marginal. And it's not really fixing this productivity problem in the UK, which is that we just haven't had much productivity growth since the global financial crisis, and not much wage growth as a result. So almost no real wage growth for a decade. And I can't see this really fixing that problem fundamentally. Although the cut in national insurance contributions is a positive, I think that's a good move, and at least it's positively impacting growth. So at least it's moving the needle in the right direction. But is this a kind of fundamental change in our economy which is going to get everything going again? I really don't think so. This is just a tiny incremental change. Now let's turn to inflation, because remember, the government the government can also affect inflation by stimulating the supply side. So if they have too much stimulus, remember, that's what caused everyone to panic a year ago with the Liz Truss budget. And they were stimulating the economy at the same time as we had very high inflation. Inflation has fallen a lot, but the question is what they've done going to increase it further? And what's interesting is, yes, unfortunately, compared to their March forecast, the Office for Budget Responsibility thinks that yes, inflation will be higher. But the reason for that is that wage growth has been very strong. So that's the tight labour market in the UK. There are lots of jobs available for every person who's out of work, and that's still the case. It is easing now, but it's still the case that we've got a very tight labour market, very low unemployment, and that's inflationary. So certainly the OBR agrees with the Bank of England here, where they say that higher nominal earnings growth, our wages increasing at over 6% per year, outweighs the effect of lower energy prices. So yes, energy prices are coming down, but wages are driving prices up. And that's an effect that's going to be sticky. And you can see that if you look at the fan charts expressing their uncertainty about their forecast, that can stay high for a long period of time. So it's not the case that we're going to fall to 2%. There's quite a lot of upside risk in their forecast if wage growth remains sticky. So unemployment will rise. That's also part of their forecast to something like 4.5%. But hopefully that'll have the effect of making the wage growth slow down. That's the hope anyway. So now let's turn to something which was mentioned a lot by commentators, which is fiscal headroom. So the definition of fiscal headroom is this is the amount of government income minus expenditure. So it's the amount of spare cash down the back of the sofa which the Chancellor has so that he can give away things like tax cuts to get re-elected. Now usually there's a big temptation on behalf of the politician to give away as much as they can and look really generous and have a resounding electoral victory. At the same time, they have to be a bit careful, because what if growth is weak? What if their income for the government through taxes doesn't grow as much as they'd hoped? Well, if that's the case and they've given away huge amounts in taxes, then they're going to have to borrow to fill the gap between spending and what they earn in taxes. So usually the Chancellor leaves a little bit of fiscal headroom in order to potentially not have a deficit later down the road. This Chancellor, however, has not done that, as we'll see. So if GDP is larger than expected, that gives you more headroom. If spending is larger than expected, that gives you less headroom. So let's look at various politicians in the past. And you can see this was a coalition government. This was yellow between 2010 and 2015. Then we had the Osborne government, which was Conservative, between 2015 and 2016. Then we had Hammond as Chancellor. Then we had Sunak, and then we had Hunt is our most recent Chancellor, of course. And you can see the average fiscal headroom was around just 27 billion, something like that. The average was 29.7 billion since 2010. However, in this case, you can see there's very little headroom. So there's something like 13 billion. So that's worrying, because if GDP disappoints, or if government expenditure is higher than expected, which is quite plausible given high inflation, that government services should cost more than people expect. If that happens, then there's not going to be a lot of headway, a lot of leeway in order to pay for that. And that means that they'll have to borrow more, and that means debt to GDP will increase. So I think there's a lot of risk of that happening. And again, if you listen to Paul Johnson, he's quite very negative about this. He says the prudent thing would have been to build a larger buffer into his plans, rather than only aim to meet the government's poorly designed and loose fiscal target by a tiny margin, which is what he did. But instead we got tax cuts which will limit the room for manoeuvre for whoever is Chancellor after the next general election, which, let's be honest, is unlikely to be Hunt. That might make for good politics. It does not make for good policy making. So there we are, very negative on this choice of having very little fiscal headroom and spending it all on these giveaways in order to push the electoral margin in their favour. The good news is, if you're on minimum wage, so my kids are just starting work, so this is going to affect them. I doubt they're watching, but it's good news if they are. This has also been increased, so that's increased from £10.42 an hour to £11.44, so that's an increase of about 10%. I think there's also a new band of between 20 and 21. Previously, if you were below 20, it was one minimum wage. If you were above, I think it was another wage. But now it's there's a new band for it. But anyway, yeah, so more minimum wage, and this was based on recommendations from the Low Pay Commission. So good news for people who are at the lowest end of the spectrum, which is many people in terms of salary. Now, if you want to look at household income, which is what a lot of us are interested in, then the latest forecast is also not particularly positive. So this is the OBR forecast. The overall 3.5% peak to trough drop in RHDI, which is real household disposable income. Remember, it's scaled down if inflation is high, per person, is still the largest reduction in real living standards since ONS records began in the 1950s. So they're referring here to this fall here, that you can see. Gradually it does recover into 2025 up to 2028, but still that is a bit disappointing. So I don't think this addresses that fundamental problem, which is low productivity growth in the UK, and that's kind of manifested here. But you can see the individual contributions of various contributors to that income growth broken down on the right hand side here, and the benefits and taxes. There have been cuts in benefits which are planned, and those are going to have a negative impact on income. So that's going to be a negative, and then you've also got the positive impact, which are higher employment, I guess, lower taxes. Those are going to increase our disposable income on average. Another thing which people in the UK are kind of obsessed by is house prices and mortgage rates, and here again, not particularly good news. And the reason for that is that mortgage rates, if you look at the forecast from the OBR, are actually forecast to increase above their March forecast. So in March they expected that mortgage rates would peak at around 4%. Now they're forecasting that it's going to peak at around 5%, although that's what many of us were expecting. And the reason they give is what the Bank of England said, which is that before the financial crisis in 2008, half of the mortgages were fixed rate. Now 85% of them are fixed rate. And that means when the Bank of England raises interest rates, it takes much longer for that to feed through into less money in people's pockets, less spending and less inflation. So according to the Bank of England, we're only about halfway through feeling the increase in interest rates in terms of economic activity. Initially, it just meant less people were getting mortgages. Eventually, it's going to mean less people going out to spend money in pubs, restaurants, shopping, and that's going to be much more painful for the retail trade, for leisure and for services. But that's where we're headed. It also means that house prices are going to fall, but it's not a crash by any means. In fact, they've revised down how much prices would fall relative to their March forecast, but only slightly. You can see there's a kind of little dip, but it's not catastrophic and it's not particularly long-lived. So by the time we get to 2029, average house prices will be above where they were today. Now, of course, one of the things people worry about is the debt, government debt, and this obviously has an impact, this budget, on government debt. And if you buy bonds, I've got gilts in my portfolio, I used to anyway, one of them is now matured. I've got an inflation-linked bond still in my portfolio. But if you look at the amount of gilt issuance, so remember, this is how the government plugs the difference between spending and income from taxes. And the bigger the gap between those two, the bigger the deficit, the more it has to issue. So all you're looking at here is the difference, really, which has to be plugged with debt. Think of this like the credit card for the government, and they've had to spend lots on the credit card in 2020 and 2021 because it was very expensive to go through that crisis. And of course, we've also had the effect of the very high energy prices. They had to pay for the energy they had to reduce the energy bills in the UK. That was a very expensive policy measure. And again, all of this has to come out of the public purse, and a lot of issuance had to come out of that. So there was a big increase in issuance in 2020, 2021, but they very carefully managed this budget so that it doesn't increase the debt to GDP ratio much at all. In fact, it remains roughly flat. So not a big pickup in issuance. If anything, the amount of issuance is going down slightly. So the net issuance, which is the black line, it's going to remain fairly steady, if not fall, into 2028, 2029. So if you buy gilts, what this means is if there are less gilts out there and the demand remains the same, so the supply's gone down, demand remains the same, then the price would go up, and that means that the yields will go down. So good news if you've already got gilts, not so good news if you're about to buy some, because it means that the yields will probably go down as a result of this change in the issuance dynamics. So not a lot of new issuance. And if you look at the debt to GDP ratio in the UK, it's not particularly high. Currently, it's around, let's see, what's that, about 80%, I think. Public sector net debt relative to GDP. And if we look on the forecast horizon, it's a bit lower than the forecast in March. So not particularly high. Remember, the US is about 120%. Japan doesn't care. It's over 200% debt to GDP ratio. But the UK, we've still got quite a lot of fiscal room. So, if Labour were to get in, they've probably got more room for expenditure. The bond market won't like it, but the room's there if they need it. But this is a self-imposed limit by the government. And in the UK, we've got quite a bit of wiggle room because we had years of austerity leading up to this pandemic. So maybe that's a good thing, maybe a bad thing, probably bad in terms of growth and productivity, but good now because we've got more ability to issue debt. And if we look at the expenditure of that debt, the cost of that debt, because interest rates have increased, there's been a huge surge in the cost of servicing the debt. Plus in the UK, we've got a lot of inflation-linked debt. About a third of our stock, I think, of bonds is linked to inflation. So if inflation surges, it becomes really expensive to service that debt. And that's the surge you can see here. So the debt interest as a percentage of revenue, that's the tax income, that's something like 10%. So for every pound we get through taxes, we're spending about 10 pence now servicing the debt. And relative to GDP also, it's looking pretty expensive. It's about 4% of GDP. And that's the highest it's been since 1956 in the post-war era. So expensive and getting more expensive, unfortunately. So again, if interest rates increase a lot, because there's so little fiscal headroom, this will reduce the income of the government and actually make it necessary potentially for them to have to issue more debt. So that's the problem with having very little fiscal room left after these big tax cuts. So that's why I think Paul Johnson was saying that the budget's a little bit irresponsible. So let's stop there. That's it. So if you've got questions, please do ask them. Don't forget to like and subscribe if you're not one of our regular viewers. Also, I'll now summon my dog because he's very good at these kind of times between me talking and you asking questions. I'll see if Laura brings him up. See, down there he's got biltong. Up here I've got his buffalo treats. He's very stinky buffalo treats. And the poor thing, he had to sit with me while I was listening to Mr. Hunt today. He didn't think much of it, but he got lots of treats. Because I was bored as well, frankly. Having to listen to politicians is not my favourite thing. Hello! Oh, I've got stinky treats for you, Ted. Yeah. You want one? Yes. Go on. Yes. Oh, he loves those. Right. Do you want another one? One more. One more. And Laura will give you biltong downstairs. You want one more? Yes. Very good. Okay, you go back downstairs now. Back downstairs. Go on. You go back to Laura. Go on, down the stairs. Ooh, there he goes. Very good. There we are. So if you do have any questions, please do ask. If you have a super chat, obviously it helps us financially. We'd appreciate it. And if you are one of our supporters on YouTube as well, we'll push you to the front of the queue with your question. Obviously, I'll talk about investment if you'd like, but I can also talk about anything else you'd like to do with the budget. Let's see what we've got. Oh, there's a question about investment straight off the bat. Oh, interesting. Yeah, this is... let me just have a sip. Vanguard, this is from Josh H. who says Vanguard now offer more accumulation versions of their ETFs on their own platform. Indeed they do. The Accumulation Developed World ETF VHVG is now available and cheaper than the ex-UK fund. Funny you should mention that, Josh, because a few days ago I just switched into the new fund. So 100% of my pension, my SIP with Vanguard, is now in VHVG. So it's an accumulation fund, and this is something I was whinging about for a long time. So it shows you they do listen to certain things. Not everything, it has to be said. So let's have a look at their list of funds, and I'll show you what I mean. Here we are. So this is Vanguard's funds, and this is building my own portfolio. And we'll look for stock funds. We'll look for global ones. I want index. I don't want actively managed. And I want accumulation. Now, there only used to be 5 funds in this list. But look, there are lots now. And the one I've just bought is VHVG, which is 0.12, this one. So I was whinging previously that I had to buy the ex-UK one, but now I can just buy this developed fund, which doesn't exclude the UK. There's not a lot of difference, but the fee's a bit lower. So instead of 0.14, it's 0.12, which is one of the cheapest out there. I think Amundi has one which is even cheaper. But yeah, nice to see that they've actually done that. And you can get it in an accumulation version, or you can get an income version, depending on whether you want the dividends to be reinvested or not. I always go for accumulation because it's just less work. The money's automatically reinvested. So that's what I prefer. Anyway, you're right, John. Indeed, that's true. There were some changes in pensions. Well, there was an interesting point, actually. Let me see if I can find it. Because I used Otter for the first time. It's this transcription thing. Pension. There was mention of the pension reform, which I thought was interesting. Although at this point, I think it's just consultation. Talking about the triple lock. So this was about effectively having a pension so that your employer can pay into the pension you choose. So in the sense that it gives you more choice, I think that's great. What I didn't like were the Mansion House reforms, which suggested that you'd have to invest in the UK if you're a defined contribution, defined benefit pension. I'll see if I can find the... No, I can't find it, of course. Work and pensions. Here we go.
The legal right to require a new employer to pay pension contributions into their existing pension pot if they choose, meaning people can move to having one pension pot for life. These reforms could unlock an extra £75 billion of financing for high-growth companies.
You can't hear that.
Provide an extra 1,000 at this. I will explore options for a NatWest retail share offer in the next...
Share offer? No, that's not it. I can't find it now. Here we go.
Consult on giving savers a legal right to require a new employer to pay pension contributions into their existing pension pot if they choose, meaning people can move to having one pension pot for life. These reforms could unlock an extra 75...
I think that was kind of interesting. You just have one pension pot for life, and if you move jobs, you can just carry that pension around with you rather than ending up with 20 different pensions from 20 different employers. So I thought that was kind of cool. I did like that suggestion. But that one's just a kind of consultation at the moment, I think. So it's not necessarily going to happen. And frankly, I don't think they're going to be around for much longer, this government. So, yeah. So I doubt that one will see the light of day. But it's an interesting idea. I like that. back to your questions. Oh, one from Scipio Africanus. Nice of you to join us. Nice to see you again, in fact. So thank you for the super chat. And you say, would you be put off investing in FWRG with a fund size of only 21 million? How does physical sampling compare to full replication? Thank you. So let me just show you that fund that Scipio Africanus is talking about. And here's a picture of Scipio Africanus, if you're not familiar. There you go. Roman general and statesman. Unlikely to be him. But let's have a look at that fund that he's talking about. So let me just get the description again. FWRG. I think it's from Invesco, this fund. Yeah. So this is an Invesco fund. It's just been issued. Oh dear. Individual investor. Oh dear. I might have answered the wrong thing. Okay. It's not letting me see. That's not good. It's not good for Invesco, that's for sure. Let me try an incognito window. FWRG ETF. So this is the one. Investor. Here we go. I don't know what I said that was illegal, but definitely they didn't like it. So the reason why this one's exciting is lots of investors are on ETF only platforms. Here I'm thinking about platforms like Invest Engine or Trading 212, where you can only buy ETFs. And there weren't really cheap global ETFs that gave you global access to stocks, which also were accumulation, which had a low fee. But this ticks all of those boxes. It's an accumulation fund. It tracks FTSE All World, so that's emerging as well as developed markets. Vanguard, are you listening? So it's not just developed. And it's also, reasonably low fee, 0.15%. Now, you point out that the assets under management are pretty low. So $39 million. But I don't know what umbrella AUM is. So I guess this is for all of the sub-funds from this issuer. Maybe it issues in other currencies in other countries. But certainly the assets under management, if that's the case, 13 billion is pretty significant. But I wouldn't panic just because it's only got 39 million in assets under management, because it was only issued quite recently. So it should say inception somewhere here. Inception date, 26th of June 2023. So whenever I see the AUM is low, I always check when the fund was issued. And this has only been around since summertime. So it hasn't had much chance to pick up momentum. But because of the fact that it's so low fee, it's global, this is like a core holding for so many investors, and it's very competitive in fee. So I think this one will pick up. So I wouldn't panic about how satisfied are you with the Invesco website? Well, not very, dear, because you kicked me out. I'm not happy at all. No, I'm very unhappy. Okay. There you are. Well, I wanted to learn about one of your products, and you failed. Were you able to accomplish what you came here to do today? Yes, eventually. Is there anything you would like to share? You failed on a YouTube live. There we go. That'll learn them. Right. Gosh, I'm such a Victor Meldrew of investment, aren't I? Right. Anyway, so I wouldn't panic about the size of it. And physical sampling, the way that works is instead of buying all of the stocks in the index, you just buy the largest ones. You don't buy the tiny little stocks. Why not? Because they're very expensive to trade. And as you're churning the portfolio, that increases the expense ratio for you to churn the portfolio, as you'll continue having to buy and sell all those tiny little stocks. Whereas if you just look for the largest stocks, those tend to be more liquid. They're cheaper to trade. The bid and offer prices are closer together. So overall, it means the expense of running that portfolio is lower. So that's why companies do physical sampling. So let's say your index has 1,000 stocks in it. You might get away with just buying the 500 most liquid stocks, and you'll track it very accurately still because they dominate the price, those 500 large stocks, but you don't pay such high fees. And would I care about that? Only if the tracking was way off. You know, if the benchmark goes up 5% and this thing goes up 4%, yeah, that would be a big deal. But it's unlikely they're going to screw that up, a company like Invesco. And I'd rather have a low fee and a slightly higher tracking error than a lower fee and than a lower tracking error and a higher fee. I think that's acceptable. So I don't have a big issue with physical sampling, really. Full replication is for the really paranoid, I think. If you really don't trust the company, not to track the index accurately. But I don't have a big issue with it. You know, if I'm put within 0.1% of the benchmark, who cares? You know, 0.1%, 0.2%, I can live with it. Hope that answers your question. And let's go back to... Oh, and Scipio Africanus says thank you. Cheers, Scipio. Oh, we've got another one. Fard Jaffrey says... Say than you, no question. Say thank you, no question. Okay. Say thank you, no question. Thank you, Fard. I appreciate it for the super chat. That's great. Thank you. And what else have we got in terms of questions? Let's see if we've got a question about the budget. Oh, here's one. Simplification of ISA is promised, but no increase to annual allowance to invest in UK promised. Yeah, unfortunately, yeah. I mean, I did recently buy a small cap UK value momentum quality fund, but they didn't exist, so I had to make my own. So I had to buy 10 stocks, and I did a filter on Stockopedia to find the stocks which were suitable. I think there are about 10 stocks that satisfied the filter, and it's doing okay, actually. You know, some of them are doing okay, some of them not so okay, but it's up slightly, so I'm happy with that. But yeah, I probably would have used any kind of UK ISA for that, but they chose not to do that. I wonder why, because it wouldn't have cost them a lot, I wouldn't have thought. Maybe the uptake wouldn't have been good. Maybe there was pushback from the fund management industry. But there's always the risk that people just wouldn't use it, I think. But anyway, yeah, no UK ISA, UK only ISA. But it is a problem, people under investing in the UK. So that would have been a solution, I think. But, you know, that's not what we're seeing. Pension entitlement for the self-employed. Yeah, I guess that would have been interesting, but it's certainly not something which was discussed, as far as I know, Jane. There were things on the pension front, but I think we kind of covered that. Just give us more money, Eddie Ward says. Yeah, I like that. What else have we got? Born to Rent. What if they convert all savings and pensions to CBDC overnight? Unlikely, I'd say. Did tax for limited companies reduce? Yes, I should have mentioned that. Did I not mention that? So the big change, actually the one which is quite expensive, was the extension of full expensing and So that this is just an ability to write off any capital gains. Sorry, this is the ability to write off business investments, certain qualifying business investments, against your income. So you pay less tax, less corporations tax, and that would have expired in 2026 in March. Now it's never going to expire. It's a permanent fixture, and it's called full expensing. So that was the corporate tax cut, if you like. There was also the business rate freeze, but that's only applying to the retail, hospitality and leisure industries. So if you're a pub, restaurant, bowling alley, I don't know what I'm trying to imagine, cinema, all of those presumably would have the business rate freeze for another year. And that's a post-pandemic thing which has just been extended for those industries. But as far as I know, there isn't a kind of company-wide cut in corporation tax, unfortunately. That would have been expensive, and also I think it would have been an interesting tax, actually, a tax cut, but that's not what they did. What else have we got? Got any other questions? How are we doing for time? What else have we got? If debt to GDP increases, will that mean the pound will keep on falling? Well, look at Japan. That's always the example, the kind of counter-example of debt dynamics which have gone completely up the wall. Debt to GDP of 200%. In fact, let's compare. You'll see how crazy Japan is compared to other developed countries. And we can use Koifin for this. Let me just get the dashboard I need, which is the economic dashboard, and share. So this is the debt to GDP. Let me move down here. Debt to GDP, and it's sorted by debt to GDP. So Japan, debt to GDP, 264%. So 2 yen in debt for every yen of GDP. Compare that with Italy, and it's way off the map. 142% for Italy, US 130, France 112, and the UK you can see is only around 100. So it looks good on the international stage. But of course, a lot of these countries, it increased a lot after the pandemic because they had to spend to stimulate their economies. The US did that a lot, and many European countries did as well. But very high debt to GDP. But UK, not so bad. But of course, the debt servicing cost is high, and because we got so many inflation-linked bonds and inflation spiked, that's also going to be a big interest expense for us. But what does it mean for the pound? Well, it's hard to actually read through debt dynamics to the effect on currency. If it really was looking like the country was going to default, yeah, it would weaken the currency. But that's really not the case in the UK. We're so far from defaulting on our debt. Gilt-edged securities is still gilt-edged. We've still got a AA credit rating, not AAA. We've still got that, and it's not deteriorating. So I think, I really wouldn't worry about that. But if the debt to GDP increased a lot, yeah, as we saw in the Kwarteng Trust budget, that would spook markets and sterling would fall like a stone. But it was very clear that this time around they were super careful about not ruffling the feathers of markets, particularly the bond market, but also the currency markets. Because remember what tanked last year, seems like longer than a year, but what happened then was sterling tanked because it seemed as if they didn't care about throwing fuel on the inflation fire and having a really stimulative budget which wasn't costed properly, which would have increased debt to GDP potentially a lot, but they didn't know because they didn't ask the OBR. But this time around, the OBR was all over it. They don't always tell a positive story, which is why politicians probably don't like them. But I think that's why they're valuable, because they provide, one measure of truth as to how the budget will affect the economy, which is always valuable. And it's great that we have that. I'm really grateful that we do have that. In the US, they have an equivalent office, which is called the Congressional Budget Office, the CBO, which looks at debt sustainability, just like the OBR. And I think it's a great idea. I love it. UK is a poor country in Western Europe, and they're still stuck in 1800 centuries era. Harsh, but partially true. I did a video about how the UK, if you strip out London, the average wealth in the UK by region is comparable to the poorest state in America, to Mississippi. So very poor country with one wealthy region is how it's characterized. And that's just a fact. You look at GDP per capita broken down by region, and that's just the way it is. And this was a tweet from John Byrne Murdoch, who's a data journalist for the FT. If you don't follow him on Twitter, you should just have a look. He's very good. And while I'm plugging, let me just mention our podcast, Many Happy Returns. And this is podcast. Here we go. So this is our podcast, and I do this with Michael Pugh, who's my co-host and overall genius, who makes it all work and flow. And it's all about debt dynamics, Treasury doom loop, the world's most dangerous trade. So there we go, kind of an exciting one. And this was about the basis trade in treasuries and how it could potentially be problematic down the road. Plus, it's kind of interesting to see what institutional investors do, hedge funds in particular, and all the crazy stuff they do in terms of their trades, and the potential repercussions of those high risks that they take due to leverage. Anyway, that's the latest episode. Kind of interesting. If you're into debt and you're into scare stories, that's a good one. So back to your questions, and I'll do one more and then we'll draw a line under it, I think. C. Mark says, at least there's not been a Kwarteng-like market reaction. I didn't look at the market reaction today. I assume there wasn't a huge move in markets. One more question. Oh, here we go. How good? This is from Steve. How good do you think the OBR forecasts are? They seem to have revised them a lot in 6 months. They make this point themselves, actually, which is that it's very difficult to make these forecasts when you just get shock after shock after shock. And the shocks I'm thinking about here would be Russia's invasion of Ukraine, which affected energy prices. And of course, before that, we had the pandemic. It'll be really nice to have 1 year when we don't have a huge macroeconomic shock, particularly for the OBR, because it'll make their forecast more likely to be somewhere near the truth. But I think, the energy price shock was the biggie when it comes to inflation. But look, at least they have a go. And what's good is they show the working, so you can see why they've said what they've said. They're very transparent about that. And, I think it's a lot better to have it than not to have it. And to have it be independent rather than just listening to what the politicians say. Because frankly, who can trust a politician? That says a lot, doesn't it, if you trust an economist when you compare them with a politician. But still, there we are. The forecasts are useful, I think. Anyway, look, let's draw a line under it there. If you are watching this in replay, then please do like and subscribe. Don't forget you can join me for a one-to-one session, a power hour for coaching. You can find that on our website, PensionCraft.com, or you can just join our community and learn more about investing that way. Just go to PensionCraft.com and look at our online premium membership. It's very little per month, and you get to talk to all of us on Slack, and it's quite a vibrant community now with lots of communal experience. So, you won't be on your own. You'll be learning with other people who are like-minded, and people are very friendly and helpful. And, there's been discussion of the budget today, for example, the autumn statement today, which was quite lively. Anyway, look, please do join our community or one-to-one. Anyway, and if you don't do that, we'll meet again at the next live stream. So take care, everyone, and I hope that was useful, and we'll speak again soon.